Moreover, in a rapidly evolving banking system, underpinned by technological advancements of tectonic magnitude, no regulator can afford to situate the system at a point of time. The role of the regulator is to guide its evolution within guardrails that ensure stability, fairness, and resilience. In India, this philosophy has found steady expression in RBI's approach towards regulation, what might be called responsive conservatism, a model that prizes stability yet remains open to reform, change, and improvement. In this context, while all of you are aware, you are all veterans in this field, but I think it would still be germane to briefly recap the developments of the past decades in the financial system, in which we have made huge strides, as you are all aware. SBI has become a $100 billion bank that is also part of this journey. So post the GFC, in the wake of aggressive fiscal and monetary stimulus, the ensuing regulatory forbearance sowed the seeds of the twin balance sheet problem: over-leveraged corporates and stressed balance sheets of the banks. Coupled with the manifestation of external sector vulnerabilities, India got clubbed amongst the so-called Fragile Five. Guided by the principle never to waste a good crisis, the period from 2014 led to a foundational surgery to restore the long-term health of the financial system. This was driven by a series of regulatory measures aimed at recognition, resolution, and recapitalization of the banking system. The AQR, initiated in 2015, compelled banks to recognize the true state of their loan books, bring hidden NPAs onto their balance sheets, and significant improvements were also brought about in the supervisory framework. Simultaneously, the Prompt Corrective Action Framework, the PCA framework, helped restore the health of weak banks. It was followed by consolidation of 27 public sector banks into 12 by 2020. These measures, complemented by massive recapitalization program, strengthened the balance sheets, the capital buffers of the banks, and restored their capacity to resume healthy lending. SBI chairperson was just now mentioning as we entered that in 2018, they were in a loss. And today they are a $100 billion company. The introduction of IBC in 2016 and the pursuant resolution paradigm introduced through out-of-court workout mechanisms have fundamentally transformed India's credit culture. Parallelly, major reforms were taken to strengthen monetary as well as macroeconomic stability. This includes the adoption of the flexible inflation targeting regime, the deepening of the forex markets, and the gradual liberalization on the capital account. The recent past has also seen a number of transformative measures. Financial intermediation has now become a sophisticated and layered system. There are nimble fintechs and NBFCs that assume a greater role in origination. Development of capital markets and credit risk transfer channels such as securitization now provide a conduit for risk transfers. The project finance directions issued recently address risks arising from regulatory approvals and availability of land, etc. The proposed forward-looking ECL provisioning will force earlier recognition of the deterioration in asset quality and provide for appropriate loss buffers. Moreover, all of you are aware, Indian banks today are far more mature than they were a decade ago.